Welcome back to the deep dive. Today we're tackling SoundHound AI, that's ticker SOUN. We're going deep into the fundamentals, management, the risks, basically stripping away the hype, all based on info up to September 24th, 2025, when it closed at $18.05 a share. And there's this real tension with SoundHounds, and there you've got this incredible growth, like triple digits, and really unique voice tech that's, already out there in cars, drive thrusts. But at the same time, the losses are just staggering, and it's trading at, what, 56 times forward sales? That's huge.
So the big question we need to ask is this company truly visionary, like on the verge of dominating the market? Or is the market just paying way, way too much for, well, another voice in a really crowded space?
And that polarization is exactly why we need this deep dive, because, the analysts themselves are all over the map. When we get to the valuation part, you'll see these educational models suggesting intrinsic values from, get this, a negative $1.65 per share.
Wow. Yeah, negative. All the way up to a super bullish $28.58 per share. It's a massive range. And that current price, $18.05. It's sitting almost smack dab in the middle. That tells you everything about the uncertainty and, frankly, the execution risk we're about to get into.
Okay, let's start digging. First up, Chapter 1, Business Analysis. What is SoundHound actually doing? How do they make money?
Right, so at its heart, it's a software-as-a-service play, a SaaS model. They license their proprietary voice AI tech. The main money streams right now are pretty standard. Licensing fees, royalties, think big automakers paying to put their tech in cars, and then subscription fees for their Houndify platform. Oh, and some legacy ad revenue from an old music app, but that's less important going forward.
Okay, but the sources seemed really focused on this other idea, the usage-based and transaction fees, this voice commerce ecosystem.
Yes, exactly. That's the potential game changer. The big idea is, what if SoundHound becomes kind of like the Visa or MasterCard for anything you buy using your voice? So imagine ordering, I don't know, a coffee through your car's voice assistant, or maybe paying for something complex at a drive-thru. If SoundHound's AI makes that transaction happen, they get a tiny slice, a percentage of that sale.
Okay, like a toll booth for voice purchases?
Sort of, yeah. If they can scale that, it's huge. They move way beyond just selling software licenses and tap into, well, potentially limitless commerce.
But for that to work, the tech has to be absolutely top-notch, right? They talk about speech-to-meaning and deep meaning understanding. What does that actually mean for someone using it?
It means supposedly faster and more accurate responses. You see, most systems apparently have to, transcribe your words first, then figure out what you meant. SoundHound claims their tech does it all in one go. It interprets complex sentences, even with background noise, in a single step.
So, back to that drive-thru example. If I say, get me a large iced coffee, 2 pumps vanilla, skim milk, hold the whip, their system just gets it. Instantly, even with traffic noise.
That's the claim. And that single-step understanding, they say, leads to real benefits, like up to 35% fewer errors in understanding you, and it responds maybe 4 times faster. That speed and accuracy are critical in noisy places like a car or a busy restaurant. And that's probably how they got into, over 10,000 restaurants, places like Chipotle, White Castle, and big car brands like Hyundai and Mercedes.
Okay, but this market is packed. You've got Google, Amazon, the giants. Where does SoundHound fit in?
Their angle is being the leading independent platform. That's their key differentiator.
Yeah.
The value proposition for, say, a big bank or an automaker is use our tech and you keep control of your customer data. You own the brand experience. They don't want to just hand over their customers to Google Assistant or Alexa, right?
Right, so SoundHound offers this powerful kind of white label alternative, but being independent must have downsides.
Oh, absolutely. They don't have the massive built-in user base or distribution channels that Google or Amazon have. Every big contract win is a hard fight, probably expensive.
Which requires a big sales effort, I imagine.
Exactly. And that expensive contract-by-contract grind leads us right into how the management team is trying to grow.
Good transition. Let's move to Chapter 2. Management evaluation. We've got the co-founder CEO, Dr. Kevin Mohajer, leading the charge. And their strategy seems to be all about super fast growth, mainly through buying other companies like SYNQ3, Amelia.
Yeah, that M&A strategy is definitely their main tool for scaling up quickly.
Yeah.
But it's a high-wire act, really risky. And we're already seeing some negative fallout. For one, their gross margins are actually declining. That's because they're buying these other companies, some with lower margins, just to grab market share faster.
And didn't they also disclose some pretty serious issues with their financial reporting, like material weaknesses?
Yes, that's a big one. Earlier this year, they reported material weaknesses in internal controls over financial reporting. That's not
Totally.
good. It actually led to them filing their financials late, and predictably, it sparked a federal securities class action lawsuit. It really suggests their M&A ambition got way ahead of their ability to, handle the basic accounting and integrate properly. Classic growing pains? Maybe, but serious ones.
How long does it even take to fix something like material weaknesses and internal controls? That sounds like a fundamental plumbing issue, not a quick patch.
You're right. It's not quick. It takes significant time, money, hiring the right people.
Yeah.
And it pulls management focus away from, building the actual product. And when you look at how efficiently they're using their capital, well, it gets starker. The return on invested capital, the ROIC, over the last 12 months it's negative 68.13%.
Minus 68%.
Yeah. And you compare that to their estimated cost of capital, their WACC,
Right.
which is around 70.82%.
Okay, let's unpack that. For every dollar they've invested in the business, they're currently losing about 68 cents. That's pretty alarming value destruction. If it's that bad, why keep pushing the M&A so hard? Is the market just ignoring efficiency for growth?
I think that's largely it. The market seems willing to overlook the current inefficiency, betting heavily that achieving massive scale later will eventually make up for the cash burn now. But yeah, it's a huge gamble that future profits will justify today's losses.
Which takes us neatly into Chapter 3, Financial Analysis. This really feels like a tale of two companies in the numbers. Let's start with the good news, the bull side. That revenue growth is just phenomenal. I mean, it went from about $46 million in 2023 to nearly $85 million in 2024. And then Q2 of this year, 2025. Revenue was $42.68 million. That's a 217% jump year over year. Management even raised their guidance for the full year, basically expecting to double 2024's revenue.
Yeah, on the top line, they are absolutely crushing it. It shows there's real demand for what they offer for that independent platform.
Okay, now for the flip side, the cold water, profitability, or rather the lack of it. Their operating margin for the last 12 months is negative 175.3%. And the net loss just in Q2 2025 was almost $75 million. How do you reconcile growing revenues that fast with losing $75 million in 3 months?
Well, it points directly back to the cost of that growth. Integrating those acquisitions, building up the sales force, R&D, it all costs a fortune. And it shows up in their cash flow. Free cash flow is just consistently deeply negative. Over the last 12 months, it's negative $112.78 million. One source literally described it as lighting cash on fire to buy market share.
Ouch. Okay, so how long can they keep lighting cash on fire? What's their runway look like?
Well, the saving grace for now is their balance sheet. It's actually quite clean. Very little debt to equity is only 0.01. And they have a decent chunk of cash, about $230 million. So that gives them breathing room. But, and this is a big but, most of that cash came from selling more stock, issuing new equity, which means existing shareholders are getting diluted.
Right. And all this leads to that valuation point we mentioned. Since they're losing money, PE is useless. So we look at price to sales, and it's around 56 times.
56 times sales. It's astronomical. Just for comparison, think about NVIDIA, a hugely successful high-growth AI leader. NVIDIA trades around, 26 times sales? SoundHound is more than double that.
Yeah.
Valuation like 56x means the market isn't just expecting growth. It's expecting like a decade or more of absolutely perfect execution, hitting every target, fending off giants like Google, and successfully turning that voice commerce dream into massive real profits. It's pricing in near perfection.
Okay, let's shift gears. How does the market feel about SOUN? Let's look at Chapter 4, Market Sentiment, because the signals seem mixed, to say the least.
Yeah, very conflicted. You look at Wall Street analysts, the overall consensus is a moderate buy.
Yeah.
That suggests they believe in the long-term story, the technology. But then you look at their actual 12-month price target, the average, the median, they're somewhere between $10.70 and $15.42. That's significantly below the current $18.05 price.
Wait, so the analysts are basically saying, yeah, we think it's a good company, but the stock's too expensive right now.
That's pretty much the message, yeah.
Yeah.
Long-term potential, short-term overvaluation, and maybe the most glaring signal is the short interest. It's incredibly high. We're talking 32.90% of the public float is sold short. That is a massive bet against the stock by, presumably, sophisticated investors who think the price is way out of line with reality.
But having that many shorts, that can cut both ways, can it? It creates volatility.
It absolutely does. It's a huge vote of no confidence for sure. But it also loads the spring for a potential short squeeze. All it takes is some unexpected positive news, maybe a killer earnings report, a huge new contract, and those shorts might be forced to buy back shares quickly to cover their positions, driving the price up sharply. So you have this intense bearish pressure, but technically the stock has been trending up. trading well above its 50-day and 200-day moving averages. It's a real tug of war.
Interesting. Okay, what about who actually owns the stock? Let's cover Chapter 5. Ownership structure.
Ownership looks pretty solid on the surface. Institutions own a good chunk, almost 44%. Think big names like Vanguard, BlackRock, Bank of America, though a lot of that is likely passive index funds just tracking the market. Insiders also hold the decent amount, around 10%. That usually helps align management's interests with shareholders.
But any nuances there? Are insiders buying or selling?
That's the subtle point.
Yeah.
While the 10% holding is good, there haven't been any recent open market purchases by insiders, discretionary buys because
Right.
they think the stock is cheap. Most of the recent activity has been sales under pre-scheduled 10b5-1 plans, which is normal.
Yeah.
But the CEO, Dr. Mohajer, did sell about $2.5 million worth at $20.30 a share. The lack of insiders stepping up to buy more shares at these levels, it's maybe a neutral to slightly bearish signal about how they view the current valuation.
Got it. Okay, let's put all the pieces together in Chapter 6, risk assessment. We can use that SWOT framework: strengths, weaknesses, opportunities, threats.
Sounds good. Starting with strengths. Definitely their proprietary tech, those 250-plus patents. Their position as the leading independent platform is key. That accelerating revenue growth is undeniable. And crucially, that strong balance sheet with low debt and high cash.
Okay, weaknesses. The flip side of growth is the severe unprofitability and that high cash burn. Those documented weak financial controls are a major concern, along with a lawsuit, the extreme valuation we keep talking about. And the risks tied to that M&A strategy integration is hard, and it's hurting margins right now.
Now looking ahead, opportunities. The market itself, conversational AI, is massive and growing fast. There's potential to expand into other valuable areas like healthcare or finance. And of course, the big one, that potentially highly scalable voice commerce ecosystem, if they can make it work.
But the threats loom large. First, just brutal competition. Google, Amazon, even NVIDIA, which is ironically an investor, but also a huge AI player, they all have immense resources.
Right. And then you have the broader economy. Higher interest rates make capital more expensive for SoundHound itself, but maybe more importantly, they squeeze their corporate customers. Enterprises get cautious, they delay projects, they demand much faster, clearer ROI on software spending. That puts pressure on SoundHound to deliver profits sooner rather than later.
And we shouldn't forget geopolitical stuff, right? Even if SoundHound isn't directly hit by, say, tariffs.
Exactly. Things like the U.S. tariffs from 2025 could hurt their big clients, especially in automotive or electronics. If those clients face financial pressure from trade disputes or supply chain issues, their IT budgets are often the first thing they cut. That could indirectly choke off SoundHound's growth pipeline.
Which raises the question, can they diversify their customer base quickly enough to weather downturns in specific sectors like auto? That seems like another risk.
Definitely an execution risk, yeah.
Yeah. All right, let's bring it all home. Chapter 7, conclusion. Let's summarize the core arguments. The bull case seems pretty clear. It's a pure play on a booming market. They have unique tech, growth is exploding, and they have cash to fund it for a while.
And the bear case is just as clear. The valuation is completely detached from current reality. There's no clear line of sight to actual profit. They're burning cash rapidly. The M&A strategy is fraught with risk, and they're up against the biggest companies in the world. It's all about execution risk.
And we have to circle back to that valuation range one last time. Educational models spitting out numbers from negative $1.65 up to $28.58 per share.
And just to be clear on that negative value for an analyst to reach that conclusion, they essentially believe the company's future cash burn and potential liabilities are worse than the liquidation value of its assets today. That's how deep the skepticism runs in the bear camp.
So with the stock at $18.05, right in the middle of that huge range, there's really no margin of safety, is there?
None whatsoever. Buying SO at this price isn't really a typical investment decision based on fundamentals. It's a pure bet. A bet on management pulling off a very ambitious, very difficult plan over many years, and finally turning all that impressive revenue into real, sustainable profit.
So given that massive short interest, over 32%, and the price being way above analyst targets, here's the final thought we'll leave you with. Is this extreme volatility just the market recognizing a stock that's fundamentally overvalued and heading for a crash? Or is it the sound of a tightly coiled spring, just waiting for the next piece of good news to trigger potentially the biggest short squeeze of the year? Okay, that's our deep dive on SoundHound AI. Hope you found it useful. If you did, please hit like and subscribe to Stock Analytics AI. For just €4.99 a month, members get priority requests for deep dives. We're planning to cover the entire S&P 500 over the coming months, and members get first dibs. Or if you just want a one-off analysis on a specific stock, drop us a super thanks.
And the necessary reminder, This analysis was generated by an AI system purely for educational purposes. It should absolutely not be taken as financial advice. Always do your own research, or better yet, talk to a qualified financial advisor before making any investment decisions.
Thanks again for tuning in. We'll catch you on the next deep dive.